Hi, thank you for joining us for our quarterly market update. My name is Jason Gunkel, and I lead our investment team here at Severson Strage. The global financial markets have reacted strongly to the actions by Russia to invade Ukraine and the uncertainty it creates for the global economy. The global stock market, as represented by the MSCI World Index, has dropped over 10% since the beginning of the year to be considered an official market correction. We are recording this about 2 weeks prior to the end of the quarter, and of course the market could move between now and the time that you are watching. There has been a wide range of returns in the stock market, with growth stocks that have returned the most over the last several years, including many technology stocks taking the biggest hit year to date. While the value side of the market, which includes many energy and financial stocks, has fallen much less. The bond market has also struggled as interest rates have been rising rapidly. The Bloomberg U.S. Aggregate Bond Index is down a little over 5% year to date. This all according to Morningstar. The biggest news in the world in the financial markets has been the invasion of Russia in Ukraine. While the human cost of war is not easily measurable, and our deep sympathy does go out to those affected, the Russian invasion has created a lot of uncertainty for the markets. Western nations have responded by dropping severe economic sanctions on Russia. In addition, many Western banks and businesses have announced that they are halting operations in Russia and sales to Russian companies. The result has been a significant drop in the Russian stock market and the value of its currency. The sanctions have, for the most part, not targeted Russia's energy exports. While the U.S. only imports about 3% of its oil and gas from Russia, and recently announced it was banning those imports, the European Union relies on Russia for about 40% of its oil and gas. So far, Russia has been inclined to reap the benefits of higher energy prices, but it could get desperate to retaliate and cut off its exports to Western nations, including Europe. If that happens, Europe would most likely be the most affected, but the rest of the world would also be impacted by the lower energy supply. Russia is the world's largest exporter of wheat, and along with Ukraine, account for more than 25% of the world's wheat supply, according to the Observatory of Economic Complexity. Many emerging market countries, including Egypt and Turkey, would be affected the most by a drop in wheat exports, but again, the food shortages would be felt across the globe. People are already feeling the pain of inflation as they shop in grocery stores or pay for gas at the pump. The annual inflation rate rose to 7.9% in February, which was the highest rate since 1981, according to Kiplinger. This will likely get a little worse before it gets better. Kiplinger also reported that the inflation rate is likely to hit 10% in March. However, they project that by the end of the year, inflation should decline to about 6.5%. The long-term forecast for inflation also paints a better picture. According to 36 forecasters surveyed by the Federal Reserve Bank of Philadelphia, headline inflation will average about 2.5% annually over the next 10 years. Also, by looking at the current rate of the Treasury inflation-protected securities, investors believe that inflation will be a little higher over the next 10 years, but just under 3%. Meanwhile, the Federal Reserve is caught in the middle of rising inflation and slowing economic growth. Right before its March meeting, when it has been widely expected to begin raising interest rates. The Fed has been signaling tighter monetary policy for months to combat inflation, and the expectation is that it will raise short-term rates by 0.25 point at each of its next 6 meetings through the end of this year. This also reported by Kiplinger. There has been a lot of positive economic news that has caused the stock market to have very good days as well. Almost all of the companies in the S&P 500 U.S. stock market index have reported their earnings for the fourth quarter, and 76% of them have beaten earnings expectations, according to FactSet. Corporate profit margins are the highest they have been in 70 years, according to data from the U.S. Department of Commerce. The U.S. Department of Labor's most recent job report also showed that 678,000 new jobs were added to the economy in February, which well exceeded the expectations of economists. The unemployment rate continues to trend downward and now sits below 4%. Consumer spending accounts for more than 2/3 of the U.S. economy, and households are sitting on about $2 trillion of savings built up while not spending as much during the pandemic. As the COVID-19 infections continue to drop, consumers are likely to boost spending further. 150% more people are expected to fly this year compared to last year, according to the International Air Transport Association. In addition, the Commerce Department showed that business spending continues to rise and beat expectations this year as well. The U.S. is currently in what's called the MidCycle phase of the economic recovery, where growth rates are still relatively high, but past their peak. On average, the stock market performs well during this mid-cycle phase, averaging returns of nearly 15%, although not as well as during the early recovery phase like we saw last year. It is also worth noting that volatility picks up during this mid-cycle phase, and many stock market corrections have occurred like we've seen this year. This is all according to Fidelity. For the financial markets the rest of the year, the key question is whether Russia-Ukraine war will result in a European recession. Schwab estimates that the odds of a recession in Europe are above average, but still below 50%, and that Europe's recent economic indicators are relatively strong. We wouldn't be surprised to see the second half of this year turn out much better than the first half if inflation trends downward while companies continue to earn record high profits. Of course, it is difficult to predict the future. While the market can drop during wars and crises, it has always proved to be resilient, and we believe this time will be no different. Investors who are able to look past the negative headline news are rewarded by their discipline and ability to stick with their investment plan. When the U.S. stock market has dropped between 10 and 15% in the past, it has taken just under 5 months on average to recover, according to data from Morningstar. Our investment team continues to monitor the markets very closely, including the events in Russia and Ukraine. It is important to remember that we have designed our portfolios to be diversified and withstand events such as this. We will stay committed to protecting the value of our clients' accounts. Thank you for joining us today. If you are a current client, we look forward to talking with you soon. If you are not a client, we would welcome the opportunity to discuss your unique situation, and you can call us at 515-225-6000 or visit us online at onlyworkforyou.com. Take care.